Welcome back to the deep dive. Today we're really jumping into a tricky one.
A huge one.
Yeah, the whole world of blockchain technology and the crypto infrastructure behind it. Trying to keep up with it feels like, I don't know, mapping a jungle that's growing around you.
It's a perfect analogy. And because it's so dense, our whole goal today is to give you a clearer path by focusing on just one thing, a specific vehicle designed to track it.
The iShares Blockchain and Tech ETF, ticker symbol IBLC.
That's the one.
And that's our whole show today. So, welcome to everything you need to know about finance. This is, by its very nature, a risky subject, but understanding the mechanics is everything.
And look, we should probably get this out of the way right up front.
Right.
What we're doing here is an impartial analysis. We're just looking at the publicly available data, the performance, the risks. This is absolutely not financial advice or, an endorsement of any kind.
Exactly. We're just here to unpack the information. And hey, if you find this kind of deep dive useful, please take a second to like and subscribe. It really helps.
So our mission today is to pull IBLC apart, see what it holds, look at why it's so incredibly volatile, and really synthesize the unique risks you take on when you try to buy into this whole universe.
Okay, let's start with the basics. For anyone who might be a bit newer to this, when we say ETF or exchange-traded fund, what are we actually buying?
You can think of it as a basket of stocks, in this case anyway. Instead of you having to go out and research, say, 39 different companies.
And buy them all one by one.
Right. You just buy one share of the ETF. It gives you instant diversification across that specific theme. And this is key. It trades on a major stock exchange like the NYSE all day long, just like a single stock.
So who's behind this one? Who's managing this high-tech basket?
Well, it's BlackRock. It's under their big iShares brand. And their objective is really specific. They want to track an index of companies, both in the U.S. and outside of it.
So it's global.
It's global. And they're laser focused on companies that are deep in the, development, innovation, and actual use of blockchain and crypto tech.
So this isn't just a broad tech fund. It's very, very specific. What are the numbers, the metrics, telling us about its size?
Well, it's still pretty small, which tells you it's a niche play. As of, say, mid-November 2025, it has net assets of around $90 million.
And how many companies in the basket?
39 holdings. And the whole idea is that it's dynamic, it's meant to adapt as the tech evolves, but, to get that professional management and that global reach, there's a cost.
The expense ratio.
Exactly. It's 0.47%.
0.47%. That's definitely higher than, a simple S&P 500 index fund. Why would someone pay that?
I think that price really reflects the complexity. You're paying for BlackRock's expertise in navigating all these different jurisdictions, these different regulations, and their rules for picking which companies even qualify.
So you're paying them to filter out the noise?
Pretty much. You're paying for the research and the instant global access to a space that's, frankly, really hard to vet on your own.
Understood. Okay, so we know what the vehicle is. But the real story here is the ride it takes you on. I mean, the recent price action, it's just a tiny piece of the puzzle.
It really is.
We saw it trading around, $51 lately? But that's just a snapshot.
You're right. To really get the picture, you have to look at its history. And it's a very young fund. It only launched on April 25, 2022.
So it was born right into a really turbulent time for the crypto markets.
Exactly. It's seen extreme highs and extreme lows in a very, very short period.
And nothing shows that better than the 52-week range.
It's just massive. I mean, it's almost unbelievable for an ETF. In the last year, IBLC has been as low as $21.46 and as high as $68.61.
Wait, say that again? From $21 to $68.
In a single 12-month period, it's a 300% difference between the floor and the ceiling. And that context makes the recent returns even more eye-popping.
Right, because the returns for people who held on have been, well, incredible. Year to date, as of mid-November, we're talking about a return of around 59%.
59%. And the full one-year total return is even bigger.
An astonishing 89.59%, almost doubling your money in 1 year.
Numbers like that definitely get your attention, but they are not free. Those returns are basically how the market compensates you for the incredible risk you're taking.
Yeah, which brings us to the most important metric of all, the beta.
Yes, the beta. This explains everything.
So let's spend a minute here. What is the beta for IBLC, and what does that actually mean for the listener?
Okay, so the 3-year equity beta for IBLC is 3.51.
Wow, 3.51. That's not a tracker, that's an amplifier.
It is a massive amplifier. So if the broad market, let's say the S&P 500 goes up 1%, this fund, IBLC, tends to go up 3.51%.
But the reverse is also true.
And that is the crucial part. If the market has a bad wind and drops, say, 5%, which happens all the time, you should expect IBLC to potentially drop over 17%.
So it doesn't just magnify gains.
It profoundly accelerates losses. The fund is structurally built to be way more volatile than the overall market. That 3.51 beta completely explains that massive 52-week range we were just talking about.
So with that kind of leverage baked in, the big question is, what's under the hood? What companies are actually driving this thing?
Right, because even with 39 holdings, it's not evenly distributed. There's a real concentration risk here.
It's skewed to the top holdings.
Heavily skewed. For example, some of its biggest recent weightings were Iron LTD at over 11%, Coinbase Global at almost 10%, and Circle Internet Group at around 8.3%. So just 3 companies make up a huge chunk of the fund.
Most people have heard of Coinbase, the big exchange. But for our listener, what does a company like Iron LTD actually do?
That's a great question because it gets right to the heart of the risk. Iron is basically an infrastructure company. So think data centers for high-performance computing and, crucially, cryptocurrency mining.
So their fate is tied directly to the profitability of mining.
Immediately and directly. If energy costs go through the roof, or if the price of Bitcoin drops, the profitability of mining collapses. And the impact on IRN, and therefore on over 11% of this ETF, is immediate and painful.
That's the definition of sector concentration risk.
It is. And beyond just a few companies, the whole sector is still considered an emerging technology, which, brings its own set of problems.
What does that mean in practical terms for the companies in the fund?
It means a lot of their business models are, frankly, still unproven at a large scale. The competition is intense, but it's not just company against company, it's protocol against protocol.
Can you elaborate on that? Protocol versus protocol.
Sure. It's the risk of becoming obsolete. Think about the race between different blockchains or which scaling solution will become the industry standard. If a company like Circle is heavily built on one standard and a competitor's tech becomes the new favorite,
then Circle's value could plummet.
It could be devalued incredibly quickly. You're basically betting on the winners of a technological war where the rules are changing constantly.
And let's not forget the elephant in the room, the price of crypto itself.
The link is profound. IBLC doesn't hold Bitcoin directly, but its company's valuations are tied directly to it.
How so?
Well, if there's a huge crypto market crash, the revenue for an exchange like Coinbase just dries up overnight. The profits for mining companies like Iron, they just disappear. It creates this very powerful, very leveraged negative feedback loop.
And it feeds right back into that 3.51 beta.
Exactly. Then there's the global aspect. We said it holds U.S. and non-U.S. companies. That adds a whole other layer of risk, jurisdictional risk.
Which a purely U.S. tech fund wouldn't have to worry about.
Not to the same degree. You have currency risk, political risk, but the biggest issue here is regulatory fragmentation. Different countries are treating crypto and blockchain completely differently.
Can you give us an example?
Sure. Let's say a major economic bloc, maybe in Europe or Asia, decides to ban a certain kind of energy-intensive mining for environmental reasons. Since IBLC holds global mining companies, that one decision in one market could just devastate the business model for, 10 or 15% of the fund's assets. And it wouldn't matter what U.S. regulators were doing.
And that just highlights the core issue. The whole regulatory framework is still being written, which means the goalposts are always moving.
Precisely. You're investing in a sector where any sudden move by, say, the SEC or another global body can send massive shockwaves through your entire investment.
So to try and bring all this together for you, IBLC offers a single diversified way to get into one of the highest growth areas of tech on a global scale.
But, and it's a huge but, you have to understand the trade-off. The price for that access is extreme volatility. It's that 3.51 beta combined with deep concentration in just a few companies and all the risks of an emerging and maybe even fleeting technology.
It's very high-stakes play.
It absolutely is.
Which brings us to the final question. Given all that, what's a reasonable long-term view here? How should someone even think about putting this kind of asset into a portfolio?
Well, I think the future of IBLC is tied completely to the real-world adoption of blockchain. I mean, for things beyond just speculative trading.
For actual use cases.
Yes. Tangible, scalable use cases. Because so many of its holdings are still tied to unproven models, it's probably best viewed as a smaller, complementary piece of a portfolio.
Like a satellite holding around a more stable core.
Exactly. A thematic satellite focused on fintech innovation, but certainly not a core defensive asset.
And that leads us to our final provocative thought for you to consider. Given the huge concentration risk in just a few companies, and the constant threat that a new, better technology could make them obsolete, which is the greater long-term threat to IBLC? Is it the unpredictable regulatory changes from governments around the world?
Or is it the sheer pace of innovation itself? The possibility that the tech underpinning its top holdings today could simply become obsolete in 5 years?
That's a tough question. Market risk versus political risk.
And figuring out which one you're more exposed to is really key.
Absolutely. Thanks for joining us on this deep dive into IBLC. If you want to get up to speed quickly on other complex topics, be sure to try out our latest episodes. We'll see you next time.